Alright, we just talked about valuing your inventory based on 4 different possible methods that can be used in accounting. The one caveat to that is that accounting principles require that inventory be reported at the market value of replacing the inventory when the market value is lower than cost. So you might have paid something for the inventory that you have, but if the market value has dropped, then you're supposed to report your inventory at the market value, not at what you paid for it. This is referred to as lower of cost or market. So whichever one is lower is what your inventory should be valued at, either what you paid for it or what the market value is now worth if it is less than cost. So we're talking about current replacement cost of purchasing the same inventory items in the usual manner. So LCM, or lower of cost or market, is applied either to each individual item separately, to major categories of items, or to the whole of the inventory. If your items that you have in inventory are very different and unique, then you're probably going to use the first way there, to each individual item separately. Alright, so in this particular textbook, they're just going to show you how to do applying lower of cost or market to individual items. So up here they're showing you a particular example, and they're talking about the particular types of, I guess these are either motorcycles or something. Yeah, I'm assuming they're motorcycles. So they have 20 units of Roadster, 10 of Sprint, and then so on and so forth. 8 of whatever that says, Trax 4, and 5 Blazers. They show you what they paid for it, but they show you what the market value is. Now remember, you're supposed to record your inventory at the lower of cost or market. So if you look here, cost is $8,000, market is $7,000. So the lower one here is the market price. So you're going to have to adjust your inventory because you recorded it initially at cost. But because market has dropped, you need to adjust your inventory to the market price. In this case, cost is lower, so you would keep it at cost. In this case, cost is lower, so you would keep it at cost. But here, market is lower, so again, you're going to have to adjust your inventory. So if you use the figures that you have here, lower of cost or market applied to the items is going to give you $265,000 as opposed to the $295,000 that you originally recorded. So when you originally recorded the inventory, you did it at cost, which came to a total of $295,000. But now, by looking at these figures and comparing cost to market, you determine that your inventory is only worth $265,000. So there needs to be a $30,000 adjustment. And the way we do that is just the way it's listed right here. You do a journal entry, you debit cost of goods sold, and you credit merchandise inventory, because this takes the amount out of inventory. You know, because inventory is an asset, so the normal balance is a debit, so you credit it by $30,000. Now, the main reason why you're doing this is to be consistent with the conservatism principle in accounting. Accounting says that whenever possible, we need to be conservative in our estimates and in what we think what our profit is going to be. So by lowering the amount of the inventory here, we are being conservative. We're applying that particular principle in this situation. So this would be the next, after you've determined your inventory based on the 4 methods we've already discussed, you still have to do this at the end of the period to determine whether or not the cost or the amount that you report for your inventory is at lower of cost or market. This last section just kind of explains how it affects your financial statements if you make errors in calculating inventory. And I'm not going to go through all of that, but this again is important. I've already discussed it in the last video, but if you are not accurate in how you calculate your inventory cost and your cost of goods sold, then your financial statements will be incorrect. And it shows you here what happens if you understate or overstate your ending inventory and the impact it has. It's not just in the first year, but it also applies to the second year, because your ending inventory figure becomes your beginning inventory figure for the next year. So screwing up your inventory costing will affect your financial statements, generally speaking, in 2 periods for sure, and often in 2 years because it carries over into the next year. So read through this carefully and make sure that you understand how that's going to impact your financial statements if you make a mistake in those areas. One of the other things I want to mention is that often at the end of the chapters they have these ratios. In this case they're talking about how to calculate inventory turnover, and they show you how you do that by taking cost of goods sold and dividing by your average inventory. There's also the figure, the ratio for days sales in inventory. How long is your inventory sitting before you resell it? And there's a formula for that. These ratios are often used in the business world to help companies judge where they stand compared to other companies, and they're often reported in financial statements so you can compare similar companies to each other. So please take a note of that, because I think some of the homework that you're being asked to do takes into account these ratios that are found at the end of the chapters.